This is our Forex blog for October 5th, 2011. And like most days, we really want to trade the currencies that are strongest against the weakest. Some days, like you can see today, currencies such as the dollar and the yen are showing mostly weakness. Whenever there's more red at a higher peak than green, that weakness is likely to continue. The longer it is red and the least amount of time it is green, also increases the chance of the weakness continuing. But as you can see, the real-time strength of weakness, which is made up of 5 different statistical trend tools, 3 of them measure the direction, and 2 of them measure the intensity of the direction. So anytime it hits 80 and higher, not only are the majority of the dollar pairs and yen pairs going down, but they're doing so with, significant intensity. Underneath that, we have the intermediate time frame trend, daily, weekly, and monthly. So in a perfect world, if the dollar and the yen were showing mostly strength today, we'd love to buy them because, all the time frames would be up. Today it's, a counter trend day for the most part. You can see the Australian, which has an extremely weak weekly and monthly trend, was showing strength today. Now, when you're trading and you see some strength in a currency where the longer term trend's down, and weakness in the dollar and yen where the longer term trend is up, you can still trade in those directions, but most of the time it doesn't last for more than 1 to 3 hours. Today it did. So, when you get into these trades, look for any sign of the trade not working. When you're fighting the longer term trend, you're less likely to be profitable. You can see the Swiss, a little bit of strength, weakness, for the most part, mostly weakness from 2 to 5. Then you had some strength right here. The weakness came back in. There's no more strength. It's safe to assume the weakness will return because all the time frames are down. This is what normally happens. Most of the time, the momentum will follow the longer term trend. And when you spot, the real-time weakness here that matches the longer term trend, which is down, the Swiss is a good currency to sell. If you can't find a currency that's strong on all time frames to buy against the weak Swiss, then at least, find a currency that was most consistently strong throughout the day, like the CAD or the Australian. The Australian was very strong all day, even though the weekly and monthly trend's down, just like the Swiss. Once you were pretty sure that there was less upwards momentum than the previous weakness, and at 8:30 it became weak again, buying the Australian versus the Swiss is a pretty high probability trade because the dollar and the yen were weak all day. And also the CAD was, relatively consistently strong, even though the weekly monthly trend are also down. You can see the weekly monthly trend are down less in the CAD than the Swiss, even more so than the Australian. So if you're looking for high probability trades on days like this, which are harder to trade, the Australian Swiss would have been a good one to buy after 8:30 when you had a very high probability of this currency going up. Again, a little bit of strength right here. This one was, for the most part, weak all day. The daily, weekly, monthly's down. You have some strength here, some weakness, some strength comes back, but not intensely strong. It's under the 80 level. And so at 8:30, it's likely to go back down again. And, the Australian was strong all day. So after 8:30, you're looking to buy this. You might have bought the breakout of the high, and you can see it only went up about 10 pips and came back down, so you probably lost 5 pips in that one. And then you bought the next breakout here, and this one worked. So you lost 10 pips, or maybe you lost 5 or 6 if you move your stop up like I do. And the market shot right through the first fib target, kind of stalled the second one. I would have got out right here at 88.70. That's a 30 pip move. You lose 10 pips, then you make 30. You netted 20 on that trade. Let's look at the CAD Swiss. Also, this is a little bit lower risky, higher probability trade because the CAD is not quite as weak as the Australian on the weekly and monthly trend. And this one really never had any intense weakness except for about 3 o'clock. Just a little bit, a few bars of just mild weakness, a lot of strength here at 7. And so when this one broke out, and a lot of times when you buy breakouts, you want to put your stop a few pips underneath, the sideways consolidation before it broke out. You never got stopped out of here, and this just continued up. You might have wanted to get out of half of your trade here when it stalled. Draw your fibs on that wave, and it'll give you an idea of it's a pretty good place to get out of your second half now. You would have been out of half at 88, maybe a half at 30, so your average exit was 15. You're in this trade around, let's just round up to 70. So you made 45 pips while risking 10 or 15, and this trade worked. And it was an obvious higher probability trade than the Australian Swiss, because the Australian had such a strong downtrend on the weekly and monthly trend, whereas this one didn't. Now the pound, the weekly and monthly trend's up. It has a lot of strength here, but from 6 to 8, it has a lot of weakness, and it has pretty much less strength right here. So you don't know if this strength's going to continue or not. And of course, it doesn't. It's not anywhere near as clear as the Australian and the CAD. Now you could, just because of the fact that the dollar and the yen have a weekly and monthly trend that's up, you could, take a shot at buying the dollar Swiss, especially after about 7:30 to 8:30. Strong dollar, weak Swiss. Here's 7:30. Here's 8:30. You can see it did go up, but it didn't quite go up that much, and you can see it only went up 30 pips. If you would have bought here with your stop underneath the low here, kind of went up a little bit. If you, realized that the dollar was weak today and you weren't being greedy, you might have just got out at these fib targets. Notice both of them held. The first one, pulled back 10, 15 pips, came back up, hit this one, pulled back 30 pips. And if you bought that pullback, the next fib target, I'm not sure if it even got hit, because the market's not that strong. Actually, it did. It got hit almost to the pip. So if you got into this little pullback right here, I wouldn't have bought until the market kind of went sideways and broke out. Maybe you would have bought this at 92.10 with your stop underneath the low. It went up, came down, starts going up. You're moving your stop up. Goes right to the fib target. For whatever reason, if you don't get out when the fib target gets hit the first time, if it gets hit the second time and it can't go through it, you're an idiot not to get out of that trade. So, that's a nice little 30 pip move. And there was maybe a 10 or 15 pip move earlier. Because the Swiss is weak on all time frames. And the dollar really, wasn't consistently strong today, but the weekly and monthly trend is up. And most of the time, like you can see in the dollar Swiss today, you'll make money trading in a currency in the direction of the weekly and monthly trend. Now the yen appears to me to have more intensity to the downside than the dollar does. So if you see some, currencies like the euro that has the monthly trend slightly up, the weekly trend, moderately down, it had a lot of strength here, an hour of weakness, a little bit of strength, less weakness. It's pretty much safe to assume, because the last momentum move had intensity was to the upside. At 6 o'clock right here, you might consider buying this against whatever's weak. The yen was consistently weaker, I think, than the dollar. So I would have, at 6, looked to buy the euro yen. Here's 6 o'clock. This one's very choppy. One of the reasons for that is because it's stuck at the previous week's low, which is acting as a support area, and the Fibonacci retracement area that I draw each night for all of our mentor students that automatically shows up on your chart. This is a major resistance area where there's likely to be some selling, and there was. So, at 6:30, when this, found support again and broke back above the hourly, this is kind of a risky trade. I might take this just, out of boredom, but most of the time I'll avoid trades like this. But the only reason that this is somewhat more likely to work is anytime a resistance area gets hit twice, it's much more likely, probably 3 times more likely, to go through that resistance area the third time. And so, when it pulled back here and found support here, I wouldn't necessarily buy here, but this acted as resistance. Anyone who sold here and here, when they realized that when it came down, it's found support at the same level, and it didn't make a lower low, and it certainly didn't go below this swing low down here at 68, didn't get anywhere near it. And also, on top of that, if you draw your fibs on this, let me redo that. I, for some reason, didn't click it properly. You can see it pretty much found support at the 61.8% Fibonacci area. So, anytime there is a major support level like the weekly low, Fibonacci area off the last wave up, traders who did short this the last 2 times, they're going to be a little nervous, and they're probably not going to be as likely to sell there. So there's fewer people selling there, and a lot of times when it busts through a fib level or any other resistance area, you get a big pop to the upside. Now in this case it didn't, because right above there we have another weekly pivot level. Actually, a monthly pivot level and a weekly pivot level right at the same price. So there's two major resistance sell areas right there with a lot of sell orders, and it couldn't bust through there. But at least, you can see it was a pretty high odds trade, because the yen, was weaker than the dollar. The euro looked like it was about to go up, and, it did. And this is right around 5:30 to 6:30. Let's just briefly show what our range charts look like. Here is a 6 pips per bar chart at 5:30, and you can see on this, a little bit better pattern. This pulled back and it triple bottomed right here. You can draw your trend lines over the bar's highs, and when it had a false breakout underneath the previous week's low, couldn't get underneath these previous swing lows. When it comes back up here, I would say above 102. Maybe you would have bought it at 102.02. This one just pretty much marched its way up, and you can clearly see on the chart, hit this resistance area, pulled back, came up again, couldn't break it. You got to get out of your trade somewhere around 40 to 45. But it's a beautiful 45 pip trade, and using our range charts, it's much more clear, how to trade it. As you can see, again, here's the 5-minute chart, euro yen. You didn't quite see the same pattern on the bottom. If you drew your trend lines over these 5-minute bars, I don't think you quite had the same entry. Possibly did. I personally love the range bars. I think they're vastly superior than time-based charts, and you can much more accurately tighten your stop up underneath little sideways consolidation areas, which you oftentimes don't see on 5-minute charts.